Hi, this is Ashish Shanker and I'm happy to present to you key insights from our latest version of the Alpha Strategist. It is titled the Sisyphus Challenge, which is very symptomatic of what is happening in our economy. Sisyphus is essentially Greek mythology wherein a king was cursed to push a boulder on the top of the hill, and every time he would push the boulder, it would roll down 2 steps. So every time we see that the economy is gathering steam, there has been some impending challenge that we faced. I mean, we faced the demonetization issue, we faced implementation of GST reforms, and now we are facing this NBFC crisis and the recent announcement in the budget of adding additional supply could be another overhang. So we are continuing to climb over these walls of worries. However, we are reasonably confident that the stage is set, all the reforms are in motion now, and we should hopefully look for a more smoother journey going forward. The big event, which is the budget, is past us. It was presented on Friday, and what I'll try to do is I'll try to give you a summary of the budget and our key takeaways. The budget has basically chosen to tread the path of fiscal prudence. There were expectations that the government might relax the fiscal deficit target to provide a stimulus to the faltering economy. However, the government has chosen to keep the fiscal deficit at 3.3% and walk the path of fiscal prudence. How do the numbers add up? They are basically looking at additional revenues from custom duties, excise duties, as well as the super rich tax which has been levied on the highest slab. There are 2 slabs which have been created between 2 to 5 crores and 5 crores and above, which means effectively the highest income earners will end up paying close to 42%. Now this could be a little bit of a sentiment dampener because the taxes at the highest slab are already quite high. The other announcement was basically freeing up our debt markets to foreign investors, which is a positive. What the finance minister has indicated is they are likely to borrow about 10% of the government borrowings from foreign investors. Essentially, the borrowing number has largely been kept the same. It is at 7.1 lakh crore. The net number is close to 4.7 lakh crores, which was a big relief for bond market investors, and you saw yields coming down on the 10-year bond yield. The government has further put out an additional window for NBFC funding, and it totals up to 1.3 lakh crores. This is likely to keep enough liquidity in the banking system, and it's likely to encourage them to buy out asset pools from NBFC. So some of the issues that we have seen in terms of the liquidity stress could ease off. The bond market investors further cheered, reason being that the borrowing calendar did not go up and the government stuck to the fiscal deficit targets. However, there were some sentiment dampeners for the equity markets. Essentially, the finance minister has suggested SEBI to increase the minimum public shareholding norm for listed companies from 25 to 35%, which means that a lot of companies which are closer to 70-75% in terms of promoter holding will end up selling their stake in the public market. This could bring in additional supply of close to 3 lakh crores. Normally when government announces such a measure, they do it in the SEBI normally does it in a very phased manner, and we've yet to see SEBI's verdict on this. So we'll know in the coming few days how they decide to phase out this initiative. Normally companies are given close to 3 to 4 years so that the supply doesn't crowd out markets in one specific years. There will be additional supply from the government as well. Now the intent is very good, where the government has said that their holding will be fungible to institutions like LIC, which means that technically they can go down below 50% in PSUs and it will still be called a public sector enterprise if the additional holding is kept with LIC. Now this is again good news. The sentiment dampener here is that coupled with the minimum promoter shareholding, maximum promoter shareholding norm, and the supply of paper that is likely to come from the government side, the number could be as high as 3.5 to 4 lakh crores. Now this number has to be absorbed by domestic investors as well as foreign investors. So how SEBI chooses to implement this and phase it out will be really critical from an equity market standpoint, and it's natural that equity markets will react negatively initially. In terms of the economy, they've chosen to give a little more boost to infrastructure, wherein they've mentioned that they will look to spend about 100 lakh crores over the next 5 to 6 years in building infrastructure. However, what is not clear at this point in time is how the funds will be raised. There has been a lot of talk about raising money from foreign investors, where they are going to allow foreign investors to also invest in InvITs now. But however, these are proposals at this stage, and we'll have to see how this progresses. Now, till that happens, we still believe that the government hands will be tied, because some of the assumptions in terms of revenues are a little aggressive. Although the GST tax collections, corporate tax collections, as well as income tax collections are quite moderate, and the overall growth in taxes, what they have assumed, is closer to 24%. We feel the excise duty, the union custom duties and excise duty projections are a little aggressive, so the government could fall short. So which means again a cut in expenditure. As we've seen, this government is pretty focused on ensuring that the deficit numbers are in line. So broadly, we believe that the markets will now shift to looking at company specific fundamentals. There is a growth slowdown underway. However, we still continue to expect that over the next 4 to 5 years, with a stable government and with growth coming back and interest rates being benign, the downside is currently limited, and the upside for equity investors over a period of time could be pretty reasonable. So we continue to recommend investors to allocate towards multi-cap strategies, and on a case-to-case basis, look at mid and small cap strategies, because the valuations are very attractive. The fixed income space, essentially yields are likely to come down even in the high quality fixed income space. The credit space becomes even more attractive after the liquidity initiatives that the government has taken. So we continue to watch this space. However, we are not encouraged to give a buy call at this point in time, because we'd still like to see how some of the stresses ease out, especially in the NBFC sector, which are related to the real estate sector. And then take a call on it. So it's back to basics now that the budget is behind us, which is essentially focus on your own portfolio allocation, which is which should be closely linked to the investment charter that has been built for you. Look at the risk that is there in the portfolio, and take decisions accordingly. So with that, I close my thoughts on the budget and the way forward. Thank you very much.